on the debt fund market. The RBI has conducted a lot of operations, something called as open market operations as well, on Monday. Further, yields as well are just at about 6%, though there has been some volatility over there. Now, all of this has implications on debt funds. And like I mentioned, fixed deposits too are really not giving very great, the outlook over there is not very great in terms of returns. So let's introduce on the show Mr. R. Sivakumar, the head of fixed income with Axis Mutual Fund. Mr. Sivakumar, really appreciate you joining us today on the Money Show. So to start with, I'm going to start off with a very basic question that a lot of our viewers as well ask us. When it comes to investing, the most traditional and most popular mode of investing is fixed deposits. How do debt funds essentially create a much better option versus fixed deposits?
Hi, thanks first of all for having me, and I think it's a very important topic. I think one of the things that we've seen after this pandemic has set in is a general flight to safety, especially within debt. So, and this happened on two counts. One, of course, is because debt markets have been somewhat volatile in the last 6 months, but also because there was one fund house which had some liquidity challenges, which led to some shuttering of a few funds, which again led to some amount of uncertainty, I would say, among many investors, which has, I think, led to a preference perhaps for fixed deposits. But I think if you look at over the last few months, especially now that the markets have settled down, you will see that the pain in terms of the volatility was indeed quite temporary and lasted maybe a month or two. And I think over the last few months, the markets have settled down. And I think going forward, we should not see a repeat of these kind of incidents because a lot of the issues that we saw in March and April, the volatility that we saw was specific to the start of this whole pandemic-related lockdowns and are not more generic in nature. So my expectation is that we should see investors look at debt funds in a more positive way going forward. On a more basic level, of course, when you have this extraordinary amount of liquidity that RBI has released and people are unsure how to utilize this liquidity, the first port of call is usually keeping it in a bank, etc. But I think the second port of call will be to come to capital market instruments to get that extra return, both from a perspective of a higher yield, which is typically available, but also from a perspective of better tax treatment for longer-term investors.
Okay. But when it comes to even investing in debt funds over there, the big factor is volatility in yields. So how do you invest in debt funds amidst all of this volatility in yields? And if you could share with our viewers some sort of a semblance of what sort of return expectation can one expect in fixed income or in debt funds?
I think the reality is that when you were to look at a debt fund and if you're a first-time investor and you're investing for, let's say, a longer term, by that I mean, let's say 3 years and beyond, your first port of call probably would be some of the shorter duration portfolios. Anything I would say in and around the 3-year mark, maybe a little less than that, is perfectly fine. So on a broader basis, maybe 2 years, 3 years, a little bit more or a little bit less, makes a lot of sense for most investors. That kind of matching the duration to your investment horizon, I think makes a lot of sense to start with, because that smooths the volatility over your holding period. Now, even when you're buying, let's say, a 2 or a 3 year duration fund, it doesn't mean that the fund is buying 2 or 3 year duration bonds. The fund manager is actively selecting different maturities. So, for example, in today's market environment, we are actually preferring to own some longer duration securities and balancing that out with some money market assets to create synthetic, let's say, 2 or 3 year duration portfolios. But this is stuff that we do day in and day out. And from an investor's perspective, I think choosing a fund whose risk profile as encapsulated by the duration and the credit profile, I think is all that is really necessary. The second question of yours was on what are the kind of return expectations. So here's two parts to return expectations. One is there a general trend in the market that we are riding on? So over the last 2 years, it's been a theme of rate cuts and easy liquidity, which has been causing yields to fall. And as prices are inversely correlated with yields, you have seen bond prices rise and bond returns being very, very good in the last 2 years. But that is changing. On the one hand, you have seen the RBI pausing on rates and signaling that their discomfort with inflation. So we believe that rates will probably be on hold from here on. And when you take a medium-term view, let's say over the next couple of years, we should actually start expecting the rates to start moving up. So today, when you're making an investment decision, you cannot be blinded by, or you cannot be taken in by the kind of returns that you've seen from debt funds over the last couple of years. And you should look at it more from a perspective, what is likely to do well in a rising rate environment over the next 2 to 3 years. And I think we will all try to find portfolios that are resilient to rate hikes. For example, money market assets. If RBI hikes rates in 2 years' time, it has no impact on today's money market assets because they will mature before the rate hikes happen. Right? Similarly, the long-term bonds which are today pricing in 75 or 100 basis points of rate hikes already over the next couple of years, I think will be resilient in the wake of a rate hike. So there are parts of the yield curve where we find a lot of value, and which is really what we will do. I cannot give a guidance on the returns. Our expectation is that we should continue to deliver some alpha over and above what the fund yields are. But beyond that, it's very difficult to give any kind of guidance on returns. But certainly one thing I will say is please don't look at the last year or two to get a guidance about the kind of returns that you may expect going forward.
Yeah, I mean, of course, it is difficult to give a guidance of any sort going forward, but just to understand that what really are the moving parts that determine how, debt funds could move from here on, or rather, what are the returns, that investors can expect in debt funds. So, Mr. Sivakumar, as we know, debt funds are also dependent on the macroeconomic environment. So, at this juncture, we are in the midst of the fear of the economy slowing down with, GDP contracting more than 20%. Interest rates as well are expected to either stay at these levels or will be cut down further to sort of boost the economy. Yields as well are just, all over the place. So how do you recommend retail investors essentially shuffle their debt mutual fund allocation across the different spectrum of debt mutual funds available?
I think the levers that move the market can be sometimes confusing to someone who's entering this for the first time. So it's accepted wisdom that when you have rate cuts, then the yields fall, and if yields fall, then the assets with the longest duration, which are most sensitive to fall in yields, should also be the best performers. And yet, if you look at the last 6 months, when we have had this extraordinary amount of rate cuts and easy liquidity, the longer end of the yield curve, the 10-year GSEC today is at 6, which is roughly where it was back in February or March. So in the last 6 months, the 10-year GSEC has delivered nothing in terms of appreciation. Well, all the gains have actually gone to shorter duration funds. So it's a very interesting scenario where rate cuts, the best performing asset within debt has actually been short-term assets. And my view is that as this changes, the short-term assets will underperform. Those which have benefited from these rate cuts will underperform as you move into a rate hike scenario. This can be quite confusing for investors because, how do you, it's not, for most investors, their day job to be managing bond portfolios. So I would say find an actively managed fund which kind of fits your risk profile. So if you prefer to hold AAA assets, which are highest safety assets, then find a AAA rated, maybe a short to medium term portfolio, which is actively managed, and let the fund manager take those calls about which segment of the market to own. The second thing is, I know there's been a lot of worries, as you rightly mentioned, a slowdown, which is leading to macro concern of significant deterioration in corporate performance. What you have actually seen is two things. One, yes, there was a significant impact in the first quarter. So April, May especially, affected the most by the lockdown. But as you've gone into June, July, and August, and now into September, what you see is that the economy is slowly repairing itself. We have seen, for example, manufacturing PMI going above the 50 mark, which shows growth. So it does look like at least parts of the economy are finally finding their way back into growth. And as this becomes more generalized over the next few quarters, what you will find is that the broader non-AAA space also starting to look a lot better. There will be an improvement in terms of credit quality or the perception of credit quality. And I think that will be the next place also that investors should look at. I think, again, it's a space where investors have avoided for the last 6 months for good reasons because of this uncertainty around the pandemic. But I think over the next few quarters, we must start reallocating there as the macro conditions improve. I will say two things. Be very careful about selection of the kind of names in the portfolio. And second, make sure the portfolios are highly diversified, because over the last 2 years, what we found during this entire credit challenges that we saw in post ILFS 2 years ago is that concentrated portfolios took more of a brunt than diversified portfolios. And I think if you find diversified portfolios will be highly resilient, even if there are any credit challenges going forward.
Okay. All right. So again, like you as well mentioned, right, with all that's happening in the economy right now, and I know this answer is not going to be a plain and simple black and white. It'll depend, of course, on viewer to viewer, on their financial goals, etc. But how do you recommend investors, should divvy up their money, their investable portion, that is, between equities and between debt?
So one of the important things to keep in mind is that you need to have an asset allocation plan when you go into making an investment decision, whether that is whatever that mix is, maybe it's 50-50, maybe 60-40, or whatever it is between equity and debt. That choice, it's really up to every investor based on their stage of life, the amount of risk that they can take, etc. So I wouldn't advise a huge change in reaction to the pandemic. What I will say is that it's really down to the fact that you can't make changes to your portfolio basis a price change in the market. Just because there's some price change in the market, don't change your portfolio. You change your portfolio or asset allocation only when you feel that either your risk-taking ability has changed, or of course when you have extremes in the market. If you have a market which is at extremes, either in terms of valuation or price or anything else, yes, you do look at it. The third thing you can look at when you want to make an asset allocation change could be to find new asset classes as and when they emerge. So, for example, you have seen in the recent past more of global offerings. So, to find new portfolios which could be in nature of, let's say, global equity or anything else which can give you a new angle to diversify your portfolio. The whole objective of asset allocation is to ensure that you have portfolios which are resilient, even if there is any shock to one part of the portfolio. So anything which impacts India may be very different from what impacts the rest of the world. So having that again may change. But otherwise, I would say whether you're buying equity, debt, gold, global, anything, maintain your asset allocation. Look for opportunities which can give you more diversification.
All right. Okay. So the core asset allocation should, stay put what you have, decided. Okay, just want to get in your view on a couple of, rules that SEBI has brought about, and I'm just going to sort of brush them up for the benefit of our viewers. First one has to do with mandatory disclosure when it comes to debt funds. Now, like I mentioned, debt funds sometimes do tend to have quite a few complications, but what SEBI has done is essentially mandated that debt funds disclose, all the important points with respect to debt funds, an added layer of debt scheme disclosures. So firstly, all mutual fund houses should allocate at least 10% of their total secondary markets, via the exchange. That's the first one, sort of to improve liquidity in the bond market. But further, there is also the announcement that the market regulator has mandated that debt funds should disclose their portfolios. That's all the, the notes, bonds, whatever fixed income instruments they hold in their portfolio every 15 days. Currently, the funds disclose it monthly. So now it's going to be bi-monthly, twice in a month. So let's get in your take on this, Mr. Sivakumar. Bi-monthly disclosure of funds. How do you think it will sort of help retail debt fund investors?
We have the most transparent industry. I think in terms of portfolio disclosures, we've been disclosing every month. In fact, every trade of in fixed income securities by mutual funds are disclosed. So we are very, very transparent when it comes to these disclosures. How that affects investors' lives, I think it's, a lot of this information is used by the financial press, by advisors to make judgment calls about what fund managers are doing and whether that's right for the investor. So one important advice I can give, or recommendation I can give to most investors is, please take good financial advice when you're making these decisions. I think the amount of information and disclosure, so there is a big difference between just base data and information or analytics. Right? The value is there when you take that data or the information and then put it to good use. And I think there are people out there who are putting this kind of information to good use in terms of seeing portfolio disclosures from a perspective of is there a change in the fund style, is there a change in the fund's asset allocation, etc. And that can go a long way to helping investors understand the thinking of the portfolio manager or the way this portfolio manager has acted over time. But very importantly, and this is again another very important thing, is all of these disclosures relate to the past. So these are portfolios which have happened in the past, and not necessary that the same things will be repeated in the future. So what you're seeing is really where the past track record goes to tell you something about the way the fund manager has managed the portfolio, rather than tell you anything about how this NAV will behave in the future. So it's a good guide to understand the thought process. It's a good guide to understand risk management processes, etc., of the fund. And so it's important to take that into account. But please don't use that information to make guesses about what the fund should be doing in the future, because we are all trying to figure out what is best for the future. We are not looking at the past to make decisions about the future. We are trying to make estimates about future earnings growth, future changes to macroeconomic, environment, policy, etc. So our portfolios will keep changing. But I think the disclosures that the industry is doing go a long way to giving comfort to investors that we are doing things the right way.
All right. So I guess it will essentially ensure that there's equitable distribution of information as well with respect to debt fund portfolios. If there is a possibility of maybe one corporate defaulting, everybody now is able to access that information, and if needed, redeem their fund early if they feel that, okay, this particular corporate looks a little iffy to me. So usually, it's the big entities and the institutional guys that get a whiff of such news early on. But now every 15 days, the portfolio will be disclosed. So ensure that, you do glance through the portfolio when it comes to a debt fund. The other big, news is segregation of portfolio. In the event of any sort of credit downgrade, the downgraded instrument generally becomes illiquid. So it becomes very difficult for the fund manager to dispose of such an instrument. So hence, SEBI has said that, look, you can segregate this portion or this instrument from the main portfolio. That will prevent the overall portfolio from becoming distressed and, damaging the returns generated from the rest of the instruments that, are doing well. So, Mr. Sivakumar, your view on this news piece?
Yeah, I think when the pandemic hit, when COVID hit, and you saw this global shock to credits, and I think there was a period of time when there was a worry really that globally you will see a shock in terms of credit defaults, and it was to an extent even in India there was that worry. But remember that in India we've actually been worried about credit worry, worried about the credit environment for between 1 to 2 years now. Ever since ILF has happened now 2 years ago, that was September of 2018. So for nearly 2 years now, we've been grappling with, I think, a slowdown in the economy, leading to more macro worries about credit and leading to, increased risk aversion within the mutual fund industry and with mutual fund investors. So for us, I think in the industry now, a lot of these issues have been resolved. Yes, you may still see a situation where there is a little bit of pain to come in specific companies or sectors going forward, but that's something to be watchful for. One of the points you raised about these segregated portfolios or side pocketing, I think it's very important in this context. What it does is essentially to allows the AMC to move out these defaulted or below investment grade securities into a side pocket, so it doesn't affect the main portfolio. And why this is important is that when you have, suppose you have a downgrade or a default, what happens is investors or I think a part of the investment community who is a little bit quicker in spotting this tends to sort of redeem from that portfolio, which results in the rest of the investors essentially bearing the brunt of the downgraded asset. The downgraded asset becomes a larger share of the portfolio if you have a partial redemption. What SEBI has done by allowing fund houses to segregate this is to ensure that the portfolio which is being redeemed doesn't contain the downgraded security, and therefore this information asymmetry, which could lead to some investors having better information or making use of better information, I think that goes away. Similarly, new inflows can also come into the portfolio without having to worry about the impact of the segregated assets. So for all of these reasons, I think if used judiciously, the side pocketing feature can really help investors in debt funds. What you have also seen is that when you side pocket and you eventually get recovery, we have already started seeing that recovery is getting distributed to investors in some of these side pockets, which shows that managing the side pockets separately to take care of that asset alone also has certain value in terms of getting that kind of recovery and giving it back to investors.
Okay, well, I hope that's helped our viewers and everybody watching a good explanation of everything to do with debt funds, how the current environment essentially impacts debt fund returns. Mr. Sivakumar, really appreciate you for spending this time with us to break it down for our viewers as well. Well, meantime, important news coming in for pensioners. The EPFO, which is the Employee Provident Fund Organization, now plans to pay interest of 8.5% in 2 installments and plans to first credit 8.15% to its subscribers, while the remaining will be credited in December. Remember that in March, the manager, or rather the EPFO, had announced an 8.5% interest for this fiscal year, 2019 to 2020, which is actually the lowest in 7 years. So this of course has impacted the earnings of almost 5 crore EPFO subscribers, and now remember that the EPFO is actually staring at a shortfall of 2,500 crore rupees. So this is a bit scary, but nevertheless they have said that they will be breaking it up and paying it in 2 installments. For those people who subscribe to the EPFO, you may not get your entire money, you may get it in chunks, and yes, we on ET Now will keep you updated with everything to do with the EPFO, and just see if this shortfall essentially should not get widened, because then it would perhaps be a bit of a cause of a concern, because how else then will EPFO sort of keep paying out the interest to the subscribers. So this is the important news coming in. Okay, for now, we will take a very short break right here on the show, but when we return, the IPO market is hotting up. We have 2 live IPOs and we've got at least another 5 more coming in 2020 itself. So how should you judge an IPO? What should you read up? What should you ignore? How should you skim through that big fat DRHP to make a decision as to whether an IPO is worth subscribing or not? Siddharth Khemka of Motilal Oswal will be joining us with his checklist when it comes to judging an IPO. Don't go anywhere.